And I think we had the TCP/IP moment for blockchain. That's what we're doubling down in order to make sure the roadmap from 2026 even enforces that more.
Hey everyone, welcome to the Level Up Podcast, presented by the Medici Network, the exclusive community for financial institutions to engage with blockchain-native funds and founders. I'm your host, David Breiter.
And I'm your host, Sean Farrell. Before we kick things off, make sure to hit the subscribe button and follow us on Twitter for the latest episodes.
This podcast is for informational purposes only, and nothing herein should be considered financial, legal, tax, or investment advice. The views expressed by our hosts and guests are their own and do not reflect those of the Medici Network, Fundstrat Global Advisors LLC, Finality CP Management LLC, or their respective affiliates. All listeners should consult their own professional advisors as to the legal, tax, financial, or other matters before making any investment decision.
Now, let's get into it.
Hey everyone, welcome back to Level Up. David and I are going to be sitting down today with Yair Cleper, co-founder of Magma Devs and contributor to Lava. Lava Network is a decentralized RPC network. The ticker is LAVA. David, why don't you run us through some high-level token stats?
Yeah, that's right, Sean. Ticker's LAVA. It's about, 13, 14 cents. Circulating market cap's not that big. It's really a micro cap, about 35 million. And maybe a small cap at best in the 140 million market cap range on the fully diluted basis. And as you mentioned, RPC network, and we'll talk about a little bit about what that means. But maybe some comparables are effectively data infrastructure that helps you access blockchain data. And Cloudflare maybe is maybe one kind of internet service provider on the traditional side comparable, but maybe Infura or Alchemy or someone in the blockchain space is maybe another comparable on the centralized side. And, so what is an RPC? Well, they're building a decentralized version of an RPC, which, you have these blockchains, they're like databases and things happen on them. There's transactions, there's, people interact with applications, they trade, they swap, they borrow, they lend. And, applications, they need a way to know what happens on the chain. And users, wallets, for example, if I'm a wallet, I need to be able to submit transactions and know that the balances I'm submitting for my users are, accurate. So they leverage RPCs, or they leverage nodes that, will index and run the chains, and they'll have the data, and they'll, provide you with an API of endpoints. And, Lava is, a decentralized version of this RPC network versus the decentralized other versions, or the centralized versions. And it's kind of in the, you could put them almost in the deep end category, I guess you could say. And Sean, maybe talk a little bit about, why they think this is important to have this structure.
Yeah, it's a crude analogy, but I've heard, it framed as kind of like a waiter that comes to your table to take your order. That's the RPC network, and it goes to the kitchen, which is the blockchain, the nodes within the blockchain, to submit your order. That's a, crude framework that I like to use. And, the whole idea behind building out a distributed network of these RPC providers is to reduce a single point of failure. I think we've seen in the centralized web instances of cloud delivery networks like Cloudflare going down, causing massive outages for a lot of web-based applications. And I think the goal here is, Lava Network tries to build out this distributed network to, reduce redundancy risk and reduce central point of failure risk, and ultimately create more robust blockchain networks.
Yeah, I think that's right. And so how does this kind of work in practice? What's the flow? Well, you might have an app or someone who wants to interact, like a wallet. You might want to interact with an app. That wallet might, need to ping the chain, ping the API from something like Lava, get some data from that. And, that might deliver the data needed to kind of perform a transaction on the chain. And, you might have chains, for example, that want someone to provide this service. So you could be a new L1 or something like that. And you might be willing to pay the Lava nodes to index and run your chain. And if you're using the data, you might be willing to pay for that API call. So here's a little bit on the protocol revenue. Obviously, it looks like there was a lot more revenue in the first half of 25. I'd be curious to hear kind of what drove that. It's declined a little bit, but, interesting to see that they have revenue, and that's good for, especially a protocol of this size. And Looks like, according to DeFi Llama, at least there is some earnings. I don't know if there's token holder profit or not and how they define that, but we'll see. And then here you just have some of the stats on, from DeFi Llama again on, what they quote the fees to be. And obviously it's trailed off a bit. So we'll try to learn a little bit more about, what that is. But they're still quoting, almost 2 million, 1.65 million annualized in fees, which is something relative to a lot of other protocols, especially for that size. Sean, how can it kind of work with, some of those fees getting generated?
That's right. It's not nothing. So like you mentioned, there are, certain blockchains that want to reduce their redundancy from an RPC perspective can, pay RPC providers, these decentralized nodes, to provide this RPC service. And here you have several blockchains that are doing just that. You have examples like Movement, Starknet, and Hedera, which are tapping into the Lava network to receive the service. And I believe, and we can talk more about this, but I believe that these networks can also offer incentives to these nodes to offer the service.
Yeah, that's right. It's kind of maybe like I imagine, people who want a liquidity pool could offer some of their tokens for the LPs, and maybe you want an RPC, you could offer some incentives to the RPCs that do provide the data on the network, and I imagine the RPCs probably get paid for the quality of the service. So I mean, the goal really is to have good quality. This is just some of the uptime stats, and I imagine the quality of service matters.
It'll be interesting to get his thoughts on how performance went during the October 10th fiasco. Wondering if there were any mishaps during that.
Yeah, I mean, I'm sure there's a lot of activity on chain then, and it's got to keep the data running. The other thing I'll just point to here is that according to Lava, they do have some token burn mechanism for the fees. So it looks like about 3% of the supply has been burned, which is it's not nothing. It's worth about $1 million. So there's some return of value, some value accrual back to token holders, and that's something you like to see. And I think you want to see obviously more of that to really justify, whether it's 40 million or maybe 150 million of value, but maybe not. I mean, revenue distributed to stakers is $1 million on 40. If you look at it on a circulating basis, that's it's a 40 PE. Although the revenue growth trend wasn't maybe not super compelling to support it in the eyes of some. 40p in digital asset or blockchain token land is actually not so bad compared to most others. Maybe a cleaner shirt in the laundry. And Sean, what are we looking at here?
Yeah, this is the overall supply distribution for the Lava network. You can see that it is relatively low float as of now, with about 28% of the total supply circulating. And they still have about 71% locked. And so, surface level, of course, you have the supply burn that could offset some of the impact of this supply coming online. But that is something that we might want to ask about when we talked with Yair.
Yeah, I think, I mean, the thing with all of these tokens is, on the flow side, do you have enough in the buybacks and the burns to really underpin big unlocks? And here's just a look at where the tokens are going to be distributed in the future. Obviously, not all tokens that are locked are going to be immediately distributed, but here's a look at how they've allocated them. And then here's just the supply schedule. And, you have some gradual increase in 26, but it really has the cliff and the jump up in 27. So, I think the hope probably on their end, and if you're a token holder in this, is that you can really get the fees and the growth going before this unlock in 2027, and that can really look to underpin the fundamentals and offset some of the flow dynamics. And yes, that's the last slide we have, Sean, before we go into the show. Is there anything else you're looking for?
Nope. I think that was a good summary. Excited to talk with Yair. Let's get into it.
Let's get into it.
Welcome back, everyone. David and I are excited to sit down with Yair Cleper, co-founder of Magma Devs and contributor to Lava Network. Yair, welcome in.
Thank you, Sean. Super excited to be here.
Yeah, great to have you. So we're excited to talk about what you guys are building, where you guys fit within the broader crypto landscape. Maybe to start things off, could you give our viewers a bit of background about yourself, a bit of background about Lava, and what problem you guys are trying to tackle in the crypto industry.
Yeah, for sure. So, just in a nutshell, my background is, I studied computer engineering, and, I was, serving a special military unit in, the Israeli army. I did a special program there, and as a cybersecurity officer. And I founded my first startup when I was 21. I know it looks like it was yesterday, but, apparently it was in 2009. I built something similar to Wix, the website building company, and I sold it after 3 years. Right after that, I did something similar to eToro, and was the first time that I bumped into trading, forex, and even Bitcoin. That was the Bitcoin in its early days. I didn't sell that company, but down the road, I founded other startups in business intelligence, even retail tech. And I was lucky enough to have two other exits. And and 4 years ago, I sat with my co-founder, and he said, let's jump into crypto. Let's do MEV. And I was like, ME what? Long story short, it was the NFT summer. Crazy pace. I came from a retail tech to the rabbit hole of crypto. Well, crazy amounts are just moving in an instant. And I was super curious about the technology. And I've seen that back then there's going to be the proliferation of chains. So not only Ethereum, Solana, and so forth, we're going to have hundreds, thousands, some says millions of different chains that representing different applications. So long story short, we decided to build Lava that's kind of to be the invisible force that keeping the on-chain economy online. Glad to dive into that a bit more in a bit.
Yeah, I think that's a good overview. So Lava's, an RPC network. Maybe tell us about the thesis, the investment thesis for both, the network, the product, but specifically and even more importantly, the token, the Lava token itself.
Yeah. So, I'm the founder of Magma Devs. We are a contributor to Lava Network, and we started designing the protocol from its early days, a bit more than 3 years ago. We were thinking about, how wallets, exchanges, to the RWA stablecoin, they are all interacting with the blockchain. How do they connect to them? Read, write, transaction. And apparently, they also have users that they need to present this information. They need to allow them make a swap, show them wallet balances, and so forth. So every time they are interacting with that, they need the RPC. RPC is the language of blockchain. It's a set of APIs to interact with the blockchain itself. Every chain has its own language. If you are a EVM chain, so basically you have the APIs or RPC of Ethereum, but then you're adding some of yourself. Solana is a different one, Move, and so forth. But at the end of the day, it's the same. This is the language that gives you the access to the on-chain economy. So we've seen that in order to get this access, you need to run nodes. You need to ask to call centralized providers, and it's very fragmented. Well, if you think about 1, 2, 3 chains, maybe it could work. But today there are hundreds and thousands of different chains there. So how does it make sense? And that's what we understood early then. If we are able to come up with a decentralized protocol aggregating the different providers everywhere in the world and allow each and every one of them to list their infrastructure, the nodes, and help them monetize that, so we can create a new invisible layer that is actually solving this problem of RPC. Because to be honest with you, nobody cares about RPC until it fails.
Just to kind of double click on all this, talk to us about kind of like the value capture or like the growth of the network and how you think it's going to work, and then how, why someone should buy the token because of that.
So I spoke a bit about the idea that the thesis, why we're here, right? What we try to solve. But you can think about the Lava token as a utility or coordination layer. If you want to use the Lava network, you need to buy subscription. You buy subscription with the Lava tokens. If you want to monetize your infrastructure, you need to stake Lava in order to say, I'm accountable for the service I make. Every month, all of the informations, the service that was served by the different node runners is being listed on chain, and the providers are receiving incentives or getting paid based on the quality of service. So the higher quality you have, more likely you receive more service, and more incentive you receive at the end of the day. This is how we started, aggregating dozens of providers in the network and serving at the end of the day requests. Are you opening your wallet? The wallet is querying an RPC provider for the balances. And then the RPC provider gives back the wallet the information that they want to present for you. This is how we started. We started with Ethereum, Arbitrum, Starknet, Hyperliquid, Near. And we've seen a crazy growth of 5x only in 2025. I can talk even a bit more about an exciting thing that you see behind me now about the network downtime, but just want to make sure that this makes sense so far.
Yeah, I think it does. Can you walk through the value flow? So if I'm a node, I buy the token, stake it, and I am an RPC provider on your network.
You stake it in a specific geolocation that you are specialized in, kind of telling everyone that needs the service, I'm specialized in running nodes in Japan. I'm specialized in South Africa. I'm based in the US, in North America. And Lava is kind of a routing layer that's routing your traffic from originated the geolocation. Why? Because it's the fastest, because you can compete much better than someone not from your region. And at the end of the day, this is how we make sure the latency, the uptime, availability, all of this, receive the highest service as possible.
Got it. So it sounds a lot like, I think you've used the analogy to Cloudflare, a lot like a CDN, more or less.
I used to do that, but it's something I'm telling, all my team from the beginning of the year. I told them, guys, we have to have redundancy. Cloudflare can fall. And all the teams, DevOps, 10, 20 years. No, the Cloudflare cannot fall. And we've seen what happened in the last 2 months with that. So we'd like to think about Lava as the always up reliability layer, that basically never goes down.
And so just getting back to the value flow. So presumably if a, wallet or an exchange or, some kind of application wants to integrate Lava with their application, they presumably pay a service to Lava for that integration.
They don't pay, they stake the Lava token. They can unstake anytime, obviously, but the stake is kind of the skin in the game. They say, I'm accountable for the service. And then the Lava protocol is routing traffic to the provider based on the level of the stake and based on the quality of service. Those are the two parameters that allowing the traffic to flow in Lava.
Just to be clear, are you talking about the supply side of providing the data in the
That's
service?
supply side.
What about the demand side?
I think we're talking about the demand side here. So who is paying the network for the service?
So imagine you are a wallet, right? And you support 50 different chains. You buy a Lava subscription, one Lava subscription to support any chain. Today, what you did in a day before Lava is basically you run your own nodes. You used a centralized provider in some of the chains, and you kind of implementing this very complicated infrastructure in each and every chain. Instead of that, we came up with the model that it gives you one endpoint and you buy the subscription, depends on how much you use it. And you buy the subscription in Lava in order to get the usage for that, and to pay the providers that giving you service. Let me know if it makes sense.
Got it. No, that makes a lot of sense. So those subscriptions, what, or I assume there are some kind of tiers. What, in terms of amounts, how do those subscription fees look?
In the early days, everyone asked, how do you come with these tiers? Like it makes so much sense. I said, yeah, I just threw it in ChatGPT, all the RPC provider, and ask what's the best way to price it. But, joke aside, you can think about that as the SaaS that we bring to token economics. If you know you're going to have 1 million requests per month, you buy the equivalence tier for that. If you know you're going to need 10 million requests per day, or 10,000 requests per second. So it's a different tier. What's interesting about Lava, it's supply and demand, exactly as you said before. The higher the demand is, so also the price is going high, and supply needs to come in order to attract more and more providers. So you use kind of dynamic pricing engine to make sure that the pricing makes sense to the end provider.
Got it. And generally speaking, what is the range of pricing that you charge?
Anywhere between $50 a month to a few thousand of dollars a month. It depends on depends on the chain, the geolocation, the traffic, and so forth. So, for example, doubling down on this on the question, like if you think about Lava incentivizing providers to join. Only in the last few months, you can check the Lava. It's on chain. It's, it's open, but you see that Lava distributed more than $1.6 million in rewards for the providers.
Right. And so are those revenues, are they remitted on chain? Are those things that folks can look to?
Exactly. Yeah. You use the Lava token in order to coordinate and distribute the rewards. But
no, but on the actual revenue recognition side, when clients actually pay Lava network, using that in, from just a high level, are those visible on chain?
Yeah,
they are. Okay.
The only thing is, the foundation presented the assistance fund in the last half a year that until that point, all the revenues that the protocol made was in the native token. So example, if we served on Near, it was on Near. If we served on Solana, it was in Sol. And only in the last few months, the foundation changed that and brought the utility to organize everything with the Lava token.
Understood. And how are payouts determined? Is there a set rate, like a percent of revenue?
You mean for a provider?
For a provider, yeah, on the supply side.
The provider is listing its own infrastructure. It means I can serve in a specific geolocation. The client receive a list of providers that automatically the protocol communicates and decide randomly which provider is gonna provide the service. At the end of the day, after each session, the protocol collecting all the data, the latency, availability, uptime, and so forth, in order to score each and every provider. So this is used for the score. The higher the score, more rewards you receive for the service you made every month.
I guess as a percent of total revenue, realized by the Lava network, how much of that is paid out? So you bring in $10 million a quarter. How much of that revenue is then, paid out in terms of rewards to providers?
At least 80% of them.
So you have this, Web3, we're a new internet, and you have all these transactions happening, and this is happening on blockchains. Someone has to run nodes to both capture those transactions, retrieve the prior transactions. And then, you have a wallet or exchange or someone who wants to know what's going on in this new internet. And they need to get that access. They either run the nodes or they don't. They prefer to use a service provider like an RPC. And say you're a Phantom and you want to, fetch a price for a DEX swap. They would use you, the RPC provider, or not you, but the network, the Lava network. So then they would contract you or whoever the company is. They'd pay for a tier for that, pay the revenue for that. That revenue would then get paid out roughly, 80% on chain to the nodes on that network for running that who are also staking the Lava token. Is that kind of the flow of the picture of things, or would you describe it differently?
You got it right. One thing I will add to that is the acknowledgement that we realized during 2025. And that happened not with Phantom, but it happened with Fireblocks. Fireblocks is distributing 10 trillions of digital assets, right? And they have thousands of different institutions. We had this routing mechanism on a chain level, but Fireblocks came to us in the beginning of the year and they said, you see that you have something inside the protocol. It's open source. Can you wrap it as a product so we can use internally in their system on the server side? And this became the smart router that would love to elaborate that with you. But you touch it right. We started from the RPC. The RPC gives one endpoint, one subscription, access to any chain. Today, it evolved to be the smart router who's the face of that.
Now, can I just talk about RPCs for a second? Because you don't, maybe you can tell us who some of the other ones, right? But you don't have to be decentralized to be an RPC. I'm sure there's some benefits, but we'll talk into that. But maybe you're, Infura or someone on Ethereum, or you're Helios and Solana. Maybe just talk about, that market overall, and then kind of what, the Lava network, how Lava network fits within that.
So 100%. So you mentioned some of the names, the biggest or the first one that were the centralized RPC providers are Alchemy, Infura, QuickNode. And they said something really simple. They say, you don't need to run your nodes. You can trust us to do that. And what we realized this year with Fireblocks is there's not a single player in the industry that trusts only one. There doesn't exist. They're always or using 2, 3, 4 providers, or running their own nodes also, or putting a backup, a load balancer, some more technical term, in order to ensure the uptime. But no one until today came and built this product that can give 100% uptime. Nobody built until today a orchestration layer that sits in your infra side for each and every of those enterprise wallets, exchanges, and really make sure that it doesn't matter which user in what country it exists, it based, it always get uptime. And this is the smart router.
Like, just sticking with the RPCs, for example, right? How much money do you think is made every year by the centralized RPCs? And then I think the decentralized pool is probably a smaller bucket, right? Like, just, in Web3 today.
I think it exists in the double digits of millions.
Double digits of millions. That might be right. I think I saw somewhere that like Infura was making maybe 4 million or something.
Send me this research.
Yeah, I can come back. I can get you that after. But what is the market share on just between centralized and decentralized RPCs these days?
The thing is, I want to be very specific about that. I'm personally not an altruist of decentralization. The decentralization is the tool in order to really make it work. It's a good question to ask. Do you need 3 providers? Do you need 100 providers? Right? And the answer is it doesn't matter as long as it works. We have today dozens of providers in the network, and you see that during last year, when everyone has outages, there was 0 outage for Lava. Some chains it happens with 20 providers, and some it happens with 5 providers. It doesn't matter, but the protocol know to call providers if they see lack of service in a chain. And that's the way to go. It's a new category that we start selling with the smart router right now. And, it's a 6-digit contract per enterprise. So I believe it's much bigger than the market today of RPC alone. Because infrastructure is not only about the RPC. You have also indexing services. You think about AI agents. There are different mechanisms in order to make sure that the access stays up. And that's the market. That's the market that we're tackling.
You mentioned Smart Router a couple times. Maybe we talk a bit about the product suite. I think we're familiar with the public RPC at this point, the API. But maybe we talk about the smart router. Can you walk us through how all of the products work together and who they serve?
So Fireblocks came to us last year and they said something very simple. We support 100 chains and, with mainnet, with testnet, probably more. And we have different providers serving us. The problem is that they go to a point in order of build or buy, right? And they said, you actually already build it. You build a layer, a product that you can plug and play the existing nodes. You can plug and play the existing RPC providers in order to assure you have uptime. And we started building that for them last year. And then Trump meme coin, this day was coming. And basically the CTO was telling me, and that's the case study we published after about that they were sitting in a war room looking how the smart router is routing traffic during that most of the Solana, RPC providers were down. It kept them 100% access during all the period. And this is the moment they decide, okay, we're gonna take all the infrastructure and move it to the smart router. We're gonna take more than 100 networks and plug and play to the smart router as the orchestration layer that gives the end customer always access. And while we did that, we bumped into many different features that the smart router has and is important. I spoke a bit before about geolocation in a specific places where the geolocation, you don't have enough providers, the smart router always finds for your provider. Another problem that we have is we call it the cross validation. Some of the providers, you don't know if the data that they provide to you is sync. Maybe this is not the latest block and they present false information to the users. Some other extreme cases, there are hackers that, hacking the nodes in order to present malicious information to the end user. And what the smart router is doing is he knows how to query different providers simultaneously and to find out if such a problem occurs, in order to provide the Fireblocks at the end of the day, the right information. Let me know if it makes sense.
Right. So, I mean, you have because you have this open network where you can get, look, it's starting with kind of the deep end thesis, right? You can build a network cheaper, with more robust capabilities. And then you have some, networking and innovative technology with the smart router to make it more robust as well. And how you provide your service, it can be competitive or more competitive than the traditional options that exist in the market today. Is that fair?
Yeah. And outages, that's a big thing during this year.
If someone like Fireblocks signs a contract, right? Do they pay you in stables, Lava token? That goes to you, right? Not directly, and then you'll kind of distribute that on chain. Or, we just had Helium on, and it's kind of similar for them, right? Like if AT&T pays Helium, or Nova Labs, for example, AT&T will pay Nova Labs in cash. Nova Labs will buy the token and give it to the Wi-Fi nodes on the network. Is it something like that in the flow from Fireblocks to the providers?
Exactly as you said, there are two options for the end enterprise, or they can buy directly from from on chain. They can buy the Lava and use the subscription, or they can buy directly from the development company. And we're going to make sure that we buy the Lava token. At the end of the day, it needs to incentivize the provider.
So you have this open network, right? And it's sticking with Helium, right? Maybe it's similar again. Helium is the only one that could sell the data of the network, right? You couldn't have someone else come and pay, or Nova Lab, sorry. It's the only one that could sell the data, the Wi-Fi data from the Helium network, right? Someone else couldn't tap into that network, collect the revenue, and pay it out. Is it that way for you all as well? Or could I start another, a biz dev entity on top of the Lava network, and then find, whoever, right? Someone to pay me for that, a new wallet, and then start paying out nodes and giving them the service in exchange? Or does it still flow through you all?
That's called the gateway. And we already have initiatives like that. Somebody can take the gateway in Solana and said, okay, in Solana, I want to be the face and give the SLA and stuff like that. Like it's an open protocol. So yeah, everyone can do that.
Okay. So that's better than actually most.
The value accrues back to the token. And that was the idea of that.
Right. But if you guys went away today, and let's just say the network is big and valuable, people still kind of wanted to use it, right? Can someone else step in and just continue to pay the nodes on the network for that service, and that service and nodes would still be incentivized to run that service?
I love this point, David, because from the get-go, I know how to build tech. I know how to sell SaaS. I built companies before, but it's the first time I'm building open source. I'm building something in the crypto world that has life, as also token out there. But we're focusing on the building. The way we design the protocol is decentralized from day one. Look at the Git. Look at the more techy stuff, the documentation. There's many different contributors that already working in order to evolve on the roadmap. Let's say if Magma Devs dying tomorrow, it's still out there. You see the network growth of 5x this year. I'm not sure where all this traffic is coming from because it's so easy to plug and play new chains. You see more participants joining the network. And I see initiative on analytics and Hyperliquid. We've seen some AI agents. Yeah, that's how a network should evolve. And that's why I'm doubling down in order to make Lava a standard. Just today, I had a discussion with Media Lab and MIT. It's a collaboration that we're working on. And I told them about this vision with the TCP/IP moment, right? I'm sorry, I'm taking the discussion from a different route, but it was really interesting to think about this analogy of the TCP/IP in the 70s. What is the TCP/IP? That's the base of how today we interact with the internet, the traditional internet. But in the 70s, there were different protocols that every time a computer was at a outage in the network and it was down, it really took all the network down. So this is when the TCP came up with professors from Stanford, MIT, and DARPA. And they defined this protocol that is much more resilient and never going down. But at the beginning, it was for military usage, but today that's how we basically communicate here. And I think we had the TCP/IP moment for blockchains. That's what we're doubling down in order to make sure the roadmap from 2026 even enforces that more.
That's all good. But so today, let's just say today, if Sean and we wanted to go sell services to some new fund, could I launch a business similar to you guys and collect revenue, pay it out? And how do I get the data from the nodes? Anyone can just get that data from the nodes by paying them?
It's permissionless. It's permissionless. One thing to emphasize, the data is not going through the Lava network because then it was super slow. There is an off-chain component and an on-chain component. The off-chain component tells the end client, those are the nodes you work with, and directly you communicate with them off-chain. Once this is done, all the data about the session, the quality of the session is being collected and brought back on-chain so we can score the providers. So yeah, everyone can come to Lava and say, okay, I'm the new smart router out there. And you work with me because I give you a better SLA from the Magma Devs team. And then, yeah, you can open a new business. And today we are specialized in exchanges. We work now with Kraken, with Bitvavo, with other exchanges. Tomorrow you can decide, I want to dominate the infrastructure for wallets. So yeah, you can go out and do that.
The other decentralized RPC network that I can think of is Pocket Network. You're familiar with them, right? And I think they had, maybe more market share and, well, I don't know. I haven't looked at the adoption lately, but the network was larger in the past. And I think you're probably larger than now. Well, I don't know in terms of nodes and stuff, but like, what do you think that, you guys have done differently that has kind of going to make you more successful than the way it's worked out for them?
Look, if there is one thing I learned in Y Combinator is never look at competitors. Just make sure your product works flawless. I really appreciate the team. They gave us the initial idea about how to build a protocol that is scalable and it simply works. I don't know what we did better. We understood that this is a full battle to make, right? There is an educational battle, right? I'm an advocate of RPC, and going out in podcasts like this, going on articles and educating the world why RPC is super important. It's a main task. And I think we did it pretty well. Nobody gives a shit about RPC. And now suddenly it becomes more and more like known, the thing. I again bring you back to my point earlier. I don't care about decentralized RPC as long as it works. So if you have 1,000 nodes or 3 nodes, there is no difference for me as long as it makes you the uptime that you need, as long as it makes your user always get access to the information, the blockchain, the on-chain information that they need.
You've come back to this point about outages several times. Maybe we talk a bit about how you guys measure performance of the network. I'm sure outages are one KPI you guys track. What other things should investors be looking at with regards to performance and adoption of the network?
That's a great point. If I can give, kind of what happened this year, you can see that from the beginning of the year, in January, I think we had downtime of Solana, of Polygon, and then we had in April the GCP outage, and just in October we had a very crazy downtime of Amazon. I was in New York, not being able even to use my credit card. And the last month we had the Cloudflare outage. So, you think about what does it actually mean if all the different RPC providers are using all the time the same bare metal, right? Or everything is consolidated into AWS, like what was the case when I jumped into crypto 4 years ago. So it's not only about the outage, but it's the main place to start when investor looking what is the reliability layer that's always keep things up. Apart from that, after you have the uptime, I would say, immediately you go into the latency. Who's bringing you the fastest information, right? What about the availability of the node? Like you can query the transaction, the node can be up. But if you need to query 9 times and only the 10 times receiving the information, so obviously the latency is slower 10 times more. I gave this example before. What about the freshness of the data? If you query a node and the node brings you data that is not synced from an unsynced node, it basically gave you an historical data when you ask what is the latest price, what is the right information that I need to give. So those are kind of the things that we're looking into the protocol level and emphasizing during what we call the quality of service process, how we score each and every provider.
Got it. Now, could you run us through how some of those performance metrics look and how they compare to some of your competitors?
Yeah, I don't have it on the top of my head, but we have the stats page. You can see different chains and how fast is that. Again, when the smart router is giving you the best latency, if you choose that, it's very flexible. So you can tell the smart router, you can turn on the flag. I want to have the best latency in every call. So immediately, because we see a series of providers. So every time the provider, the smart router can navigate, you can route you to the provider that is better. It can be different in different geolocation. It can be different in different chains and so forth. It matters also the type of the data. There's archival data, historical, and yeah, many type of data. But the thing is, Lava is able to look from above and check the real metrics in order to help you get the decision.
And then from a, we'll call it a protocol P&L perspective, I know we walked through how the value flows through the protocol. What kind of numbers are you guys putting up on the demand side, subscriber side? How many subscribers do you have? And how much are they paying the protocol right now in aggregate?
Last year, it was at the $4 million when we finished 2024. The last time I checked the stats, we have hundreds of different dApps or application using us buying subscription. You can check the stats page. There is more than 1 million unique users that are actually using Lava without knowing that. I spoke about today about the smart router that we start selling in the last 3 months. Already in this period of time, we exceeded $1 million in ARR. So I think it's super engaging and impressive in such a short time. Imagine that huge exchanges, custodians, wallets, they need to change all the infrastructure, and it takes them only a few days to do that. So from that point to get into an agreement, it looks very promising. That's what I can say.
And maybe just thinking about the growth. So maybe it's, 4 million last year. So maybe you call it, what's run rate for 25 is maybe higher, 5, 6, 7. Is that reasonable, or what's run rate for 25 so far?
I was asked by the foundation not to mention now, but it's available on chain.
Okay. And then, so let's just say we have some number, and that number is the total. Is that the 80% paid out?
Yeah, it's the same I mentioned before.
The 80% paid out. Okay. Okay.
Sorry, the 4 million, that's the 80% of the top line.
That's the RPC subscription. I mentioned about the smart router, which is a new product, a new way to generate revenue.
Smart router is going to be another line of revenue for you guys, in addition to that 4 million that you made last year.
The Lava network made the 4 million on the protocol side. The smart router, we sell license of that. And on top of that, everyone is asking for services, that this is a new line of product. Yeah.
Talk to us about kind of the opportunity, like for growth. Like how big could this be in 26, 27, 28?
I think we're going into a very interesting era because on the one hand, you mentioned before, what is the total market share for RPC? At the same time, more and more enterprise are jumping in and they want RWA and they want stablecoin. And the first thing they need is a bulletproof infrastructure. Just in a few months, speaking to, a handful of customers and reaching already $1 million ARR, I'm super optimistic about our ability to capture market share because it's really a green field. Nobody develops such a product, a smart router, that is basically internally in each organization, right? It's as if I'm telling you, okay, you have to work as an enterprise. You have to work with different clouds. No, you don't have to work with different clouds. But in the world of blockchain, if you want to access to the on-chain data, you need to have different providers. If you want then to evolve and go to other chains because your customers want other chains, then you need to have lock-in contracts with fragmentation for fragmented providers. All of this, our goal is to eliminate that and make sure that you have one point that is flexible, is open, and give you a reliability layer that basically never go down. That's my take. I was working hard with the team to make sure we have a scalable product that is able to integrate quickly. And I think now that we're getting to the end of 2025, we are there.
Now, I want to talk a little bit about like how to think about the valuation, but before to do that, I want to also get to just some stuff on the tokens supply side and how that's, how much is actually the circulating market cap is like 40 million. Is that right?
Market cap, yeah, I think FDV looking like, but yeah.
I don't know what is the FDV and what is the circulating market cap as far as you know.
I know that FTV is 150, around 150 today. Yeah,
that's right. And then what's the circulating market cap?
Not sure, but in general, I prefer less to talk about the token and those things.
What I'm trying to get to is how much of the supply is being traded, and then how much is held and staked by an RPC is where I'm trying to work down to.
Nice. So I think the last time I checked, there was at least 50 million held in stake for the providers that provided service.
$50 million or 50 million tokens?
There were 50 million tokens.
Roughly, what is that in dollars terms?
About 7
million, yeah.
So you have 50 million tokens worth about, you can even call it 10, right? $10 million. And every year they're receiving 4 million of Lava payouts. Is that right?
That was last year. Yeah. I cannot comment about this year, but yeah.
I mean, the yield on that is, assuming it was even the same or higher is meaningful, right? As a, like a free cash flow yield for a staker. Is that, let's just say run rate is 5, that would be a 50% roughly yield for running this staking Lava a 50% yield for holding Lava and then running top line yield for a provider for holding Lava and running the RPCs to get that payout. Is that, if 24 revenues plus the other, your new product line was the current rate, right, at today's prices. Is that fair?
Yeah, but you take into consideration that there was an increase in token massively in the last few months, like in the 3 months. So you need to think if the providers actually joined during this time or before, because that was much cheaper for them to join. Yeah.
So let's talk about the supply schedule, right? How does that work? Do you pay emissions as well to node operators?
It's all in Lava. It's the same. The rewards are in Lava.
I think what we're trying to ask is how much of those emissions are from that pot of revenue and how much are from inflation? What is the current inflation rate for?
The inflation is 1.7%, 2%. But it's only in the first 2 years. So basically the token is inflationary with fixed supply. And already, I think the token burned around 50 million tokens. The protocol burned around 50 million tokens.
So there's a burn mechanism. I don't think we covered that. So how does that work?
In order to bootstrap the providers at the beginning, there was I think 6% of the supply that being distributed to providers so they can come and join in different geolocation. And if it's profitable, those pools in different region, basically though the tokens are not distributed to providers and being burned.
Got it. So that's not going to be a steady state operation though. So it's not like
no. It's just for the 2 years. Lava basically is a deflationary mechanism. No inflation in the token.
That Lava that's burned is kind of like
is around 2.8% already burned from the total supply.
But that's because someone has not set up and provided a service, so you didn't allocate the set aside tokens. Is that right?
Or, which is actually the answer, there was a lot of revenue, so you don't need to incentivize providers to join.
I see.
Okay. Yeah, that makes sense.
Today they're already operating and they say, okay, we're staying, we're good. What we're paying $50, we can make 10 times more. So I guess that was the reason we did it in the beginning.
I do want to touch on governance. I would like to understand how decision making happens across the Lava network. Obviously, there's a development team in Magma, but how do decisions?
Magma never took any tokens from the inception.
Oh, interesting. So how do governance how does the governance process work on Lava?
There is a foundation that basically got 56% of the token supply, and they're orchestrating everything about the treasury. The only early contributors were the investors, the employees, the team, advisors. So those are the ones that took the other part of the supply of the allocation. But yeah, that's pretty straight governance process.
Now, are those foundation tokens? Or are they locked? Do they have a
Yeah, they have a locking of they have a release schedule of 3 years. Yeah, and then a linear schedule after the first unlock.
So if I wanted to change the network, some parameter on the network, right? How does that happen?
It's like in every other chain. You can raise a vote. There is the community discussion. There was a vote being raised exactly 1 year ago by the Tribe, Jump, and Hashkey, the leading investors. That was really interesting community discussion. But yeah, part of that, most of the discussions are on the roadmap. And now we had the first time discussion about the pairing mechanism. I was really fascinated by that. When we thought about the protocol in the beginning, we designed it in a way that maybe when it's a production, it doesn't really benefit the providers as we thought. Because, here is the theory and here is the in production mode. So, there was a proposal that passed about, what is more important, the stake you make or the quality of service? And if at the beginning we decided to have with, 50-50, the providers actually showed that this is not the way to go. So they made some changes exactly recently about that.
Great. And so to wrap things up, maybe if you could just give folks a sense for what, first, what risks do you think are the most pressing for the protocol? And maybe follow that up with what should folks be excited about? Are there any catalysts or changes to the protocol coming down the road over the next 12 months?
I think in general, this is a very interesting year, I would say, because we were expecting a different bull run, and I'm not sure everyone got it. We're seeing amazing growth in the last 3 months. Basically, I transitioned from being the CEO of Magma Devs, and we have a new guy in Israel that joined. He's also a several times entrepreneur, and he joined to lead the team. We're doubling down on the team in Israel, hired new engineering force, and I transitioned to be an active chairman. So I'm working closely with the foundation, with the communities in the last 2 months. And I think some of the results you see in practice. We starting to think about the next stage, like what we want to focus 2026, and see that there's a lot of that in becoming a standard. Discussions we have with the MIT, new companies, new enterprises coming up using the protocol, Fireblocks, I mentioned Kraken, exchanges, custodian, and more. So I'm super excited about that. The crypto environment right now is obviously something to think about. Lack of investment on the one hand, and different different narratives that I'm not sure which one is dominating the market right now. I see that in the next months there is a shift in the supply, like in the holders of the token. I got a lot of OTC deals that coming up in place, and really interested about what we're building. And that's in general the different points that I'm looking at for 2026.
Are you able to disclose any of those investors?
We just signed a deal with Stake Capital, and you can see also some new communities that just form in the Middle East, in Asia. This is in general.
Great. Well, just to wrap things up, final question. Are there any final points you want to kind of leave the listeners with and kind of key takeaways before we let you go?
As I mentioned before, I feel like the mass adoption is coming right now, and I really hope we're going to see that also in the retail perspective in 2026. This is the TCP/IP moment for blockchain, and I think we're building the layer to make sure that everyone at the end of the day will be depending on, but it's a decentralized layer that never can go down. I just gonna leave you with the question that how do you make sure your user never hit a downtime, and how you make sure we are able to protect any on-chain interaction from failures across any blockchain. That's the points that I would like to leave you with.
All right. And with that, we appreciate you coming on the show.
Thanks, Yair.
Thank you so much.
That's a wrap for this episode of Level Up, where liquid token protocols meet the sharpest minds in institutional investing.
If you found value in today's conversation, don't forget to subscribe and share it with your network.
For more deep dives into blockchain's most compelling projects, reach out to us or follow the Medici network for more insights. Until next time, keep leveling up.